You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, it's Jonathan Rose and welcome to Masters in Trading Live. At Masters in Trading Live, I get on here every day the market's open, 11 o'clock Eastern Time, go over the market, share some thoughts once in a while. We'll even share our trade in the day. Today is very exciting because I get to celebrate because man, did we have a wing dinger of a trade yesterday. This is a trade that comes up monthly actually. First Friday of every single month is the biggest number of the year. Of the biggest number of the month. So you could expect volatility. So when there's a reason to play for the long side of volatility in the beginning of the week, going into unemployment, it is an absolute no-brainer. So we did that trade and many were able to grab 100% plus return. So we're gonna go over that trade and I'm gonna walk you through why we do that trade every single time non-farm payroll comes around. It's just a no-brainer, somewhat easy trade. Let me walk you through it. All right, guys. Just to give you an idea of what our trades look like when we share, a new advanced notice trade signal has hit our screen. So we did this yesterday, and we shared this with everybody. Hey, buy to open QQQ October 4th. October 4th is Friday. So these options expire Friday. We don't want shorter term options because we want that big unemployment event at the end of the week. So we're buying the 483 strike puts for 330 or better. That's $330 per contract. Good morning. This morning we wake up, market's getting hit. Why is the market getting hit? Because it's volatile. Market's going to trade back and forth. The big number will come at the end of the week. Market got killed on the opening. We put a trade out. Hey, let's get out of our trade yesterday, buying for $330 per contract. Let's get out for $660 per contract and lock in 100%. Great trade. Here's what it looks like on the 483 strike, 665 bid at 679. The last trade is $6.80. So everybody was easily able to lock in 100%. Just to share with you from this morning, Val locked in a sweet profit. Paulie, 124%. Don, this is some fun, locking in $1,000. And then Steve here was able to do a whole bunch of trades in the QQQs and lock in 300 profit, 600 in profit, 200 in profit, 100 in profit. Boom. Micah, 100%. Dwayne, great trade. Bradley, QQQs. Scrappy, VIX getting long from 80 cents with the VIX going higher. Susie here locking in 50% profit. Woo, woo. Great job, guys. I'm really excited to share with everybody. But it's not just the Qs. This morning, we also got out of our aluminum trade. CENX set a limit order to sell to close CENX December 20th. We shared CENX when it was trading down at 12. It was strong, but then China comes out with massive stimulus, which helped all commodities across the board. CENX is an aluminum company, and this benefited greatly. The true trades that we had in CENX, long from $1.10, we closed at $2.19. Actually, we closed at $2.85, and then today's long from $1.60, we're able to close that for $2.30. So we're now fully out of our risk in aluminum, CENX. By the way, if CENX goes offered, if it trades lower, if the overall market gets hit and everything's got a beta of 1 when things start moving, if CENX goes on sale, we'll get right back in. But for right now, we're going to lock in 100% plus profit. Kevin here sold his last FCX. What a trade for Kevin here. FCX goes from 40 all the way to 52. Kevin, great trade, great patience. A mailbag question. We have this question in our MIT community. Okay, JR talked about position sizing. We ran an example where we're for a $25,000 portfolio, you may want to risk 1% on a trade, $250. Well, the question is, what about smaller accounts? For an example, a $5,000 account, would you still only want to do a trade of 1%? Or does that push one into trading in the more volatile end of the market? A newsletter with a large following focused on microcaps can have a huge spike in pricing. First, I want to address the last part of this statement. If you have a $5,000 account, for one, it's really no difference than a $5 million account. You have to slow down, you have to stop, you have to learn how to trade options. There is absolutely zero reason for you to go trade microcaps or put yourself into anything high risk. The glory of trading options is you decide what you're comfortable risking before you get into the trade. So a $5,000 account, the only thing that I would do with a smaller account versus a larger account is I would be much more attentive to just slowly growing that account. Because if you could take that account to 8,000, 12,000, it does get easier to trade with a bigger account. But with a small account, you could easily make trades for $150, $200 with a fixed amount of risk. Just be real smart. Don't put yourself into small, micro, or nano cap stocks. I don't even really know what a nano cap stock is. It sounds real little. Our unusual options activity tool yesterday shared FIVE, F-I-V-E. Now, I don't really have much of an opinion about FIVE, but we have a lot of people going through our MIT challenge. So I just want to point this out. FIVE, the trade started at 9:46 a.m. Eastern Time and continued until 11 o'clock Eastern Time yesterday. If you look at the timestamp, once those trades were done yesterday, notice how FIVE rallied throughout the day. I think these trades were very bullish that were done in FIVE yesterday. Today, FIVE is down a little bit, but I just want to use this example where always look at the timestamp of the unusual options activity trades, then look at the behavior of the stock on a short-term chart, and you'll get a good feel for the direction. More topics. We had a great upgrade in our divergence tool. When we talk about divergences, we're just trading one thing against another. We're not going to buy Coke. We're going to buy Coke only if it's inexpensive relative to Pepsi. We're not going to buy any old oil refiner. We're going to compare oil refiners that are highly correlated and buy what's inexpensive and sell what's expensive. But we had an upgrade in our divergence tool. And our divergent tool lets us know which stocks that are highly correlated are breaking down their correlation. A cool example of one of these is LPG against TNK, which you can see right here. I also have it bigger right here. These are two correlated names, two different tankers, but notice how they're like brother and sister. They're hanging out. They're always together. Once in a while, the blue will get expensive relative to the white, but in short time, they'll come together. We want to look at divergences. Right now, traders could think probably that LPG is inexpensive relative to TNK. Always doing trades relative to something else. It's a great way to protect yourself and just make smarter trades. In our all access